Realty Income is down 15% over the last year, but is it a buy now? Is it undervalued? We're going to take a look in today's episode. We're going to run it through our valuation model, getting to our intrinsic value, what we believe to be the acceptable buy price, given our investor margin of safety, as well as seeing what Wall Street forecast for this company over the next 12 months. We're also going to take a look at how their revenue has progressed in their latest quarterly accounts. We're also going to take a look to see their total cash versus total debt for a quick health check of the company. We're going to have a look at how they've performed versus some other companies in the real estate industry over the last few years. We're going to take a look at institutions. Have they been buying or selling in the most recent quarters? And we'll also have a quick look at insiders, whether or not they've been buying or selling. And as you know, we'll take a look at the dividend safety, looking at some important financial metrics for Realty Income. And we'll just touch upon the acquisition that they have done of Spirit Realty and discuss the synergies that we do expect over the next few years. So let's take a look at the company. Now it is down 15% over the last 12 months, and we can see over the last 6 months it still has been performing not that great, down 8%. Now we did sit at a 52-week low at $45. It's currently trading in the midpoint of that 52-week range with a current dividend yield of 5.5% and a P to FFO of just under 14. Now if you've been holding this company over the last 10 years, well, you'd be up 46%. Bear in mind that doesn't include those dividends reinvested. Not the greatest return, but do bear in mind that these is a company that is paying monthly dividends, and we can see its all-time high just before that COVID crash at around sub 80 at $79.83. So in terms of the top line and bottom line, as always for REITs, we do look at 5 to 10% is what we like to see. 1.3 billion reported in 2018. 2022 at 3.3 billion. That is some nice growth over the last 5 years. On top of that, we see an increase year on year, and we can see the trailing 12 months. So based on the December 2023 accounts, which are yet to be released, we're expecting a nice increase of 3.9 billion to the previous year of 3.3. Now, when we take a look at that bottom line net income, we can also see it is increasing 364 million. 870 million in 2022 and expected to increase, although slightly, to 881 in 2023. Now we do note some inconsistencies to the bottom line. It did increase in 2019, but then it did decrease all the way to 2021 before picking up. So in terms of the top line, it has been consistently increasing year on year, but we do see, even though that is the same with the bottom line, the increase over the last 5 years, it is a lot more inconsistent. Total cash versus total debt, a quick health check of Realty Income. 10 million of cash in 2018, 344 million in their latest quarterly report. And if we compare that to their total debt numerically and directionally, we can see it has gone up significantly from 6.5 billion in 2018 to 21 billion from their latest quarterly report. Now, their cash has gone up, but their total debt has gone up at a much quicker rate. It is expected from REITs, but it's something we will discuss when we look at their net debt to EBITDA metric. Now, some other companies in the REIT industry, now over the last year, this includes those dividends reinvested. Realty Income has been the worst performer, down 11%. We also see a few others that also have been negative. We have KIM, FRT and Triple N. So the whole industry hasn't been performing as it would have liked. Over the last 5 years, not the greatest return. Again, this includes those dividends reinvested. Realty Income up 12%, and we can see, other than KIM, which was up 50%, the REIT industry, even over the last 5 years, hasn't performed that well. Something just to bear in mind, but as always, past performance is never an indicator for future performance. Essentially institutional ownership, 79%. We can see over the last 12 months around 2 billion worth of sales outflows by these institutions, but we note a lot more buying during this same period. So institutions are loving Realty Income. We can see from Q1 last year, Q2 as well as Q3, institutions were buying more than they were selling. In Q4, again, a very similar story, 40 million buying versus 23 million sold. Again, though, as always, institutions buy and sell. We shouldn't be looking to copy exactly what they do, just one level of our research. Now, what we have here is Realty Income, and we are looking over the last 3 months for buys and sells. And we can see Larry Chapman, the director at Realty Income, he did sell around 3,500 shares in the middle of December, so not too long ago. He sold at a price of around $57, 200,000 worth. Now, as we always say on the channel, insider buying is a very bullish signal. Insiders tend to buy for one reason, and that is because they see the share price of a company going up over the shorter to mid-term. However, insider selling can be for many reasons and not just a bearish signal, but they could sell for financial or personal reasons. So it's just something to bear in mind and take with a pinch of salt. Now, before we jump into the essential dividend metrics and look at that dividend safety, just one thing to note with their Spirit Realty acquisition for those that are new. Essentially, Realty Income are acquiring Spirit Realty, which is in the same industry. And what we see here with the orange, this is the percentage of those essential stores and tenants that Realty Income have. Spirit Realty is in the blue. So we can see that they are increasing in these same companies. They have the same tenants. 14 of the top 20, as we can see here, overlap. But what is positive to note that the exposure is reduced in 18 of their current top 20 clients. And the same could be said for the industry. 9 of 10 overlap, whilst it is reducing their exposure in 9 of them out of their top 10. So very positive to note that exposure is being reduced in the majority of Realty Income's current clients. Again, this happened a few months ago, but something just to let those who are new to the channel, new to Realty Income, understand. In terms of the synergies, well, we can see the number of properties here that Realty Income hold and Spirit Realty, so there will be a lot more properties. In terms of their weighted average lease term, very high for both, as generally we can see 9 to 10 is fairly strong. 9.7 on average, very positive. And what I do quite like to draw out is that occupancy level is very, very high. 99% for Realty Income, 99.8 for Spirit Realty. So that is very, very strong to see. And in terms of the numbers of lease that are expiring through 2026, not as high as maybe you would expect. So that is positive to note. 15% for Realty, 13% for Spirit Realty Income. So lots of positives here in my opinion. There will be synergies that we will see with that adjusted funds from operations per share increasing over the next few years, and this will return value to Realty Income shareholders. So dividend safety score 80, it is safe. Market cap 41 billion, large cap company. And when we take a look at essentially the recessionary metrics, while they increased the dividend during the last recession, they had above average growth, so negative 1% versus negative 12% from the S&P 500. And we can see they did beat the S&P with a 43% negative return versus the S&P's negative 55%. Dividend growth, well, it has been increasing over the last full year in line with inflation, so that is positive to see. You're getting a forward yield of 5.5% whilst that inflation increased year on year. Last 5 years, a little bit disappointing, just below that inflation we advocate on the channel to get more than 4%. Last 20 years, slightly above 5%, so it isn't too bad. Bear in mind, they do pay monthly dividends, and they are a dividend aristocrat. They have been increasing those dividends for 25 years or more. In terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. 5.5 versus 4.4, we have our first sign of undervaluation. But please bear in mind, we're not looking at any of these models in isolation, and we will draw conclusions towards the end of the episode. Forward P to AFFO, 13.6, significantly lower than the 5-year average. So we have another sign of undervaluation. Sector PFFO, though, we can see Realty Income's 13.5 is pretty much in line with that of the real estate. So let's jump into the payout ratios. As always, we jump straight into the free cash flow. However, for REIT, it is a lot more volatile. So we focus on the adjusted funds from operations payout. Below 90% is the typical rate we look as a maximum for REITs. Two things that are positive here. Realty Income in 2023 is expected to be 76%, so that is great to hear. But it has also been reducing year on year. That is very positive. Does allow us to believe that dividend is safe so far based on the information we've seen. Adjusted funds from operation continually increasing year on year. A very, very positive metric that you definitely want to see in any REIT you invest. 2023 expected $4, 2024 expected to go higher at $4.13. So that consistency is expected by management to continue. In terms of sales growth, 5 to 10% for steady moderate growth for REITs. Very nice to see this over the longer term. 2023 at 24%. With this acquisition, I would expect to see some very nice increases over the next few years. Total sales then, it has gone from 780 million to 3.89 expected in 2023. In terms of the shares outstanding, well, this is typical with REITs. They do dilute your position. They don't do share buybacks, so there is no return of any excess cash. So something just to be aware of. And one point from myself, Realty Income is one of those REITs that we've analysed that does dilute your position at a much faster rate than other REITs. Something just to bear in mind. ROIC, return on invested capital. Remember, we're looking for around 3 to 5% for REITs, giving us faith that management are able to effectively allocate their capital. 3% at the bottom end of what I'd like to see in 2023, something just to keep an eye on, but over the longer term, we can see that consistency around 3 to 5%. Operating margin, very nice to see here in the mid-40s or the high 40s, in fact, year on year. It did slip in 2022 down to the 30s, but 2023 is expected to come back up to 41%. In terms of the net debt to EBITDA, well, earnings before interest, tax, depreciation, amortization shows us two things. Remember, the dividend safety as well as the balance sheet strength. We're looking for below 5.5 for REITs. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 6.21 in 2022 is a little bit too high for my liking. 2023, it is expected to come down. On a more positive note, 2024, management are guiding for this to come down even lower. So if this is the case, that is very positive for investors, and we should even see that possible dividend safety score go up to around 90. So let's jump into the valuation model for Realty Income. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, before we just jump into the valuation, for those that are new and want to join the free weekly newsletter, the link is below to subscribe. You will get a free weekly newsletter that talks about my 7 golden dividend metrics. We're going to discuss any stocks on the watch list, some in-depth dives, and as long as a lot of other information. So do click on that pinned comment below if you do want to grab a copy of the newsletters as they come. So let's jump into the valuation model. Now we have Graham's formula, and as we can see and have discussed many times, it isn't applicable for REITs, so we won't be using this model, but it is typically one we use for other companies. So we have the multiples valuation model for the first valuation. We have companies in a similar sector and size that we analysed. Their P to AFFO multiple, the average, and we have O's P to AFFO here. Based on that, the intrinsic value comes to $65. We can see now that first sign of undervaluation. But as always, do bear in mind we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have the second model, the DDM, dividend discount model. We have the yearly dividends, as we can see here. Average growth rate, we've gone for 3.14% as the average based on this. Well, in fact, we've gone for 3.25. The average, as we can see, is 3.14. So roughly in line, forward looking. This gives an intrinsic value of $67, another signal of undervaluation. We then move on to the third model, the DCF model, with the free cash flows year on year, the average growth, gone with something in line with analyst estimations in conjunction with the discount rate. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here the intrinsic value, again another sign of undervaluation. So the intrinsic value is just the average of these three models for today's episode of Realty Income. And don't forget, you can click on the pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio and your watch list. So let's start off with a margin of safety of 10%. Remember, we use this if we believe it has a wide moat, strong financial metrics, good forward-looking data. So for Realty Income, if you believe that, the acceptable buy would be $59. At a 15% margin of safety, it is pretty much around the current trading price, just a few cents shy. So for Realty Income, we do see 15% as that margin of safety in today's date. In terms of Wall Street, well, they see upside around 10%. They have a target price of $62 over the next 12 months. Now, this is one that I do hold in my portfolio. It was one that I was adding over the last few months when it was very, very low in the 40s. And it is one that I do believe if we get it at another margin of safety that is very strong, then I will continue to add. Even at a 20% margin of safety at around $53, it isn't too far from that. I will continue to add to my position for the longer term. It is one that pays monthly dividends, which isn't my strict criteria, but it is a bonus. And also with their acquisition of Spirit Realty, I would like to see a lot more value given to the investors over the next few years. As always, let me know your thoughts in the comments below. Catch you on the next one and take care.